in that case, yes, it does make sense to leave the facility open if you can, because there is real headache and real process and real cost involved in getting the loan in the first place if you were to pay it off and then all of a sudden decide you want access to bulk money again. So that's definitely worth considering.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
Hey guys, welcome back to the podcast. So today we've actually got some good listener questions for you. We've got, I think it's 5 questions lined up. And so we'll be running through those and giving you our thoughts on all of those topics. And so the ones we've got for you today are essentially around the following: whether gold is a worthy investment after its strong recent performance, a classic dilemma about choosing money or happiness when you're in your career and the trade-offs that come with that, how to invest a $10,000 inheritance for a newborn, and then we've got some about optimizing your home loan for maximum flexibility and control when you're trying to invest at the same time, and then also whether AI might actually make share market investing irrelevant. What do you think, mate?
It sounds interesting, Dave. I'm definitely keen to chat through a few of those questions. As always, everything you hear today in this podcast is our own personal thoughts and how we see things. It's not financial advice. We don't know you, the listener, your personal circumstances and situation. So anything that, we share today is general in nature. And again, just our view, which we will be the first people to admit may very well be lacking in context where necessary. We're just trying to provide a human touch to some of these questions as well. So hopefully our takes help you think through your own thoughts on this. And that's really the point of today. As long as you come out feeling like you have some better views on your own thoughts on any of these topics, we're really happy. But we'll jump into the first question today on gold as an investment. So the question is, what are your thoughts on gold? It has performed very well recently. That's the question. And it's an interesting question. I've had one of my own employees, Dave, talk to me about their own investment in gold recently, which I thought was particularly interesting. And I guess first question to throw it to you there is, what are your thoughts on gold? And I guess the precursor question to that is, do you own gold? Have you ever owned gold? And do you ever intend to own gold?
So the answer is no, I've never owned gold. No, I do not intend to own gold and don't own it at the moment. Look, I'm probably not the biggest fan on investing in gold. I mean, I have spoken to quite a few people who have part of their portfolio in gold or they're considering it. So it is something that is topical and as interesting to many people in this community, which I understand. So if we just go to the recent performance, because quite often people will only begin to look at certain assets when they've performed quite well recently. That's often the prompter that gets them to actually get curious about it. So I had a look at the gold performance in recent times after this email came through, and so there's a website that I found that was quite useful in actually comparing gold with other things like stocks, and that is longtermtrends.net. And so they have very, very long-term comparisons. So 10 years, 30 years, 50 years, 100 years, things like that. And so I had a look at the returns for the gold price over the last 10 years, and it came out at around about 180%, which is basically triple, which is pretty damn good. And the returns are higher in Aussie dollars if you look at an Aussie specific website, but that would be due to the currency movements, I would imagine. So the stocks, US stocks have performed better as well due to those currency movements as well. So the performance numbers that I'll run through in a minute will apply to both gold and US stocks when the Aussie dollar conversion is done as well. So the 180% return for gold was essentially equalized by the 180% return in US stocks over the last 10 years. So it sounds like, US stocks, one of the best performing asset classes, if not over the last 10 years or so. So you would think if gold can keep up with that, surely that's an incredible investment. But that's not really the whole story, because it doesn't factor in dividends. When you account for dividends as well, then the US stock return goes to 230%. But even still, that is fairly impressive, being able to almost keep up with the US stock market over that period of time. So I might just throw it back to you before I run through those return numbers, mate. Have you owned gold at all any time in the past? And would you consider adding it to your portfolio at some point in the future if you haven't already?
It's a good question. I haven't, at least not directly. Maybe an ETF or other managed fund I've had before, or super fund has had gold somewhere. But no, I've never directly invested in gold. Look, I don't know. I feel fairly uninformed on the topic, but there are many things in this world that are scarce. I feel like there's a certain level of nostalgia or groupthink when it comes to the gold stuff. Like there's lots of heavy metals that we don't have a lot of, and there's lots of other things that, crypto is limited supply and you can kind of get lost in that for a while. But I just have yet to be sold on it's hard to make more of it, and it's pretty kind of mentality. I don't think it's a bad investment strictly. Like it's fine. Like if someone's like, I'm putting money in gold instead of cash or something, I'd be like, cool, good on you for doing more with it. But yeah, it's fundamentally a speculative asset, and I've tried really hard to avoid speculative investing where I can, because I just feel like to be like, yeah, this is really valuable because humans like it, but like humans are also crazy. So that's my fear with a lot of it. But again, not too sure. I feel that's more true than not true in my head, but there's probably a lot of nuance there as well. Like I know some people get really confused. Like some people are like, oh, we've learned how to make diamonds, so maybe we'll just learn how to make gold. And I'm like, well, that's just a lack of understanding of chemistry. But that there's, I've never looked into, are we 100% sure we fully exhausted gold reserves everywhere on the planet? Like nearly every other resource I've seen, we always find more of it. But then someone smart would just tell me, actually, Hayden, we're sure because we x-ray the planet or something. Like, I don't know. And I try and also stay away from things I don't fully know in detail too.
Yeah, it's a bit of a conundrum. So you often find that people that are very into gold, they are very, very into gold. A lot of times it's not just something that they've got in their portfolio to diversify. It's something that they're often quite passionate about. I do think it will definitely perform better than cash and possibly better than a few other assets, but I'm not quite sure it's going to keep up with the returns generated from the stock market. And I mean, there's probably a few reasons for that. One is just simply that gold is, it's essentially a lump of metal, right? It doesn't really benefit from the technological advances that we have in society over time that allows companies to innovate and become more profitable over time. So there's no real innovation involved, and it doesn't really, although the price can increase due to lack of supply and people wanting to hold it and it being popular and favored and all of that, it just doesn't really have the same sort of tangible benefits that come with an economy and a stock market that's able to compound its cash flows over decades and decades and decades. I just find that it's missing that, right? And you can kind of see that when you look at the long-term return of stocks or the stock market versus gold. So if we have a look at some of those figures, I went back because we looked at the 10-year figure. The 10-year figure is actually pretty impressive. So I went back a bit further and I looked at the 30 years, 50 years, and 100 years. And so the figures for those are the 30-year return for gold is 755%, which is, it's pretty decent. The return for stocks, though, and the US stock market in particular, was 1,824%. And so that's with dividends reinvested as well. The 50-year return, gold was 1,829%, so 1,829. The return for the US stock market was 27,685%. So that is a lot higher. What is that, like 15 times higher or something like that? And then the 100-year return is 15,770% for gold and 1,897,000% for the US stock market, which is insane. So the longer the time frame involved, the more the additional return generated by the stock market has a massive effect due to the compounding difference over time. So it ended up being literally 100 times the return the US stock market generated over gold over that 100-year period. And the critical part is you have to include the reinvesting of dividends. You can't just compare price to price because you're missing more than half of the return because of that compounding effect over time when you're able to take those income payments and reinvest them into more shares. So that makes a monstrous difference. That I think people don't really look at that properly when they're just comparing the price of the market versus the price of gold and, so it kept up or it outpaced or whatever over that period. So you have to look at the total return, which makes a huge difference.
Yeah, that makes sense. And I was thinking about, you kind of comparing this to ETFs and stuff as you were talking. And I feel like to some extent, the scarcity element of gold kind of makes sense to me. But a part of me feels like if I had to choose between investing in, say, the S&P 500 or gold, one of them, it feels like kind of comparing an ETF to a share in some way. It's one particular metal. And there's not that many like high value rare metals in the world. Like I think platinum is another rare metal or something like that. But I think probably what scares me is even less itself and more like, is this diversified enough in my head? And maybe that's silly. Maybe you could argue the whole US economy, even if it's 500 companies, is essentially, totally undiversified because they're all hyper dependent on each other in the US economy. Maybe that's a fair argument, but there is something about the literalism of like gold metal specifically. And I feel like if there was like a more rounded, diversified way to invest in physical resources that were scarce, that humans find value in, that might pique my interest a little bit more.
Well, being in Australia, we already kind of have exposure to metals and minerals, right, with mining. So we've got a whole bunch of gold miners in Australia. So you're already benefiting from the profitability of gold itself and the popularity of gold as a metal and other minerals as well. So I suppose there's that to consider too, being an Australian specific scenario. But it's interesting when we talk about being diversified or not, because sometimes people will add gold to their portfolio strictly for the purpose of diversifying their portfolio, which is true because it does. Anything that moves differently to something else that you've got in the portfolio, you could see it as diversifying because that allows you to buy more of something when it's down and less when it's up and vice versa. So there is that argument, but the only issue I have with that is I don't like diversification for no reason. So I don't like diversification for its own sake necessarily. So I don't want to diversify into an asset that I expect to have a lower long-term return than the other asset that I have in the portfolio. So I could add more and more cash to my portfolio and I would be more diversified, or I could add lots of bonds to my portfolio and be diversified. But I don't want to do that because I expect that asset class to have a lower return than my shares. So I don't like that type of diversification. So if I was going to diversify, obviously I'm not saying gold's like that. Gold is better, that you could probably expect a higher long-term return than that. But the point I'm making is that I would rather diversify by adding other assets that I would expect to have better longer-term performance somewhere close to the share market. So that could be property, for example, where you would expect to benefit from growth and income at the same time. And I would bet that would have a higher percentage long-term return than gold would. So I'd rather diversify that way rather than diversifying with something that I would expect to be a drag, even though you get diversification benefits, if that makes sense.
That makes sense. I think that's a good view on, not getting too simplistically romantic about diversification without any deeper thought.
Another thing people like to say is that gold is somewhat defensive. Have you heard this? Like gold is a defensive investment or it's an inflation hedge and all the rest of it?
Yeah, every time the market drops, someone's posting on social media reminding me how good their gold's doing.
So I don't really like that argument either. So I guess anything that grows faster than inflation can be an inflation hedge. So that doesn't really prove anything though, because just because something grows faster than inflation doesn't mean it's always going to outpace inflation. Because if you have an inflation spike or just a normal bout of inflation, 2-3% a year or whatever, but your asset is having a drawdown or your asset is going nowhere, then it's not always an inflation hedge. So it's not fair to call it an inflation hedge. In the strict sense that someone might be trying to tie it in where it's a defensive asset and an inflation hedge at the same time. Because you can't call a defensive asset if it falls like 20 to 30% or if it falls like 40%, which happened. I had a look at the gold price and fell 20 to 30% several times since the year 2000 and fell 45% from 2011 to 2015. So that doesn't strike me as a terribly defensive asset or something that's necessarily an inflation hedge if it's going to be flat or falling for several years at a time.
For sure. And, I think, my takeaway on this overall, Dave, is gold can be interesting. Different people will argue differently about it. In 20 years, we'll all know what made sense and what didn't, time's kind of the big settler of all these conversations, and we're ever not really going to know. But I think for most people, it's like having some of your portfolio in gold is not a universally good or bad thing. I would say that, anyone listening should only ever be kind of worried if they're completely ruling out an entire asset class altogether, or if they were totally investing in it. If you had $250,000 and you put your money all in gold, I don't think that's strictly always going to be bad. I think it's just, be very aware of what you are doing, and make sure you really read up on it and think about it. But interesting. It makes me want to, think more about gold and other kind of scarcity assets as well, just medium term.
Yeah, I think the most likely scenario is over time it does perform reasonably well, just as it has in the past. But as for whether it outperforms, higher growth asset classes like real estate and the share market, I doubt it. It's possible, but I doubt it. I would expect it to perform less than that. I'm not sure exactly what, but that would be my 2 cents on it anyway. All right, so our second question is essentially around career and work-life balance. So here's the question. Should I stay with my lower paying job that I actually don't mind going to every day? The pay is $76,000 per year. I work a 9-day fortnight, 36 hours per week. Or do I continue with my uni study and have HEX debt and try for a job that pays better? Every few years, I go through a cycle of what am I doing? I need to earn more if I'm ever getting ahead. And then I'm swinging back to, but I actually like my job and the work-life balance. I'm 25 years old, renting, trying to save a deposit using the First Home Super Saver scheme, and confused. Thanks so much. Love the podcast.
Great question. I like that one. It's a fairly standard, kind of broad, philosophical, existential thing. I think that there's two things I'd have to unpack that, Dave. I think firstly, when you look at it from the perspective of, okay, should I induce a cost to my life now to have a financial benefit later? There's no real clear, broad answer other than you just got to do some real quick back of the envelope math and think about what your life, is or entails. For instance, if you're raising a family and things are going to be hard for 5 or 6 years, then it might make sense to stay at the lower one for a longer period and then, focus on a higher earning career later on. If you're at a stage of your life where you feel like you can, really bank the money, then maybe it is worth focusing on now. There's so many different scenarios of that for people, and I don't want to give like a wet answer, but it's just like it can kind of go either way. I know plenty of people that like 76K is enough. What's your end goal? I'd probably say starting with your end goal is really important, whether it's you or you and a partner. Sit down and ask yourselves, what kind of life do we want at what point, and then work backwards from that. That's going to be the answer above all else. On the uni topic, what I'd say about that is I've seen lots of people go get themselves upskilled and it paid massive results back to them. I've also seen people go get upskilled and all they do is get out of the labor force or get reduced in the labor force for years, kind of come out on the other end, hitting the bottom of a ladder somewhere else, struggling to make by anyway. And I just say on the study point, and I'm someone who's gone to university, really think, and I'm not saying you haven't, but this is just to all listeners, like really think about, have such a clear plan. Like if you're an adult with an income and a life and a plan, if you want to go to uni or study uni, don't just be like, oh, I'm going to go get a skill and then kind of find my way in that industry and build a career. Particularly as you get older and you get busier, it's just hard to grind like that. And the workforce in a lot of skilled services is more ageist as well. Not saying this person's old, but it's like, there's a lot of things you got to navigate. Whereas more if you're like, hey, I really want to be an air traffic controller. I can see there's a ton of work for that. I can see the job applications. I can see the salaries. It just says I need to go do this particular TAFE uni degree and pass a competency thing. That's like a really clear path, and that can de-risk it significantly, because I have had friends, particularly in midlife, who will go down the uni path, get out the other end and kind of still be floundering, or the work's not exactly what they thought. And then they're just kind of worse off financially. And then they've got a HEX debt, which is a psychological burden. And so, I think just keep those things in mind. But that was a bit of a ramble from me, Dave. I'm not sure what you might have to add on to any of that.
No, I think those are some pretty good points. It's tricky, isn't it? Because you're you're going to study something and putting a whole lot of time and effort and money essentially into something that you actually have no idea whether you're going to enjoy the job on the other end. It's kind of a strange thing that we put ourselves through if you go down this path. So it's very difficult to navigate, I suppose, isn't it?
Yeah, definitely. And like things change too. Like even, I'm a software engineer by background. I teach software engineering at university, and there are graduates who started in 2021 or 2022 when the industry was at its absolute peak, and job hires are way down and prospects are way down for the average graduate now because of everything that's happening in AI. And it's like, it is really hard. So you got to really look at the particular industry, and you got to be careful of hot industries. Like I've mentioned, if there's a particular industry where everyone's like, oh, that's really where all the good jobs are right now. Dave's from WA, where most of our GDP comes from. And, he's probably seen it with the mining stuff as well, where, like there'll be people be like, yeah, mining's the best thing to get into. There's tons of work there and people go study that. I mean, not to keep rambling on about the example, but I remember I used to work for the Faculty of Engineering at UNSW, and they would tell me things like the number of mining students they took in 2012 was like 300. And then by 2016, it was 5. And then it went back up to 50. And like, that was not the exact years or numbers, but, you'd know the mining boom stuff better than me, Dave. And yeah, just be really careful about the industry. I'd say for me, and I'm bringing this full circle, the careers I think for adults who have stable lives that are most interesting to go and study are like really stable careers that have just shown for a long time that they have predictable income, predictable career progression, predictable stability, and not the kind of like jobs that feel like they're turbulent or caught up in changing work landscapes.
Just reflecting on how the question was phrased, and so it sounds like the person is doing a job that they actually like so far, which is, I mean, to be honest, that's already quite a successful outcome. I think a lot of people are doing jobs they don't particularly care about whatsoever, just for the paycheck. So I'd say that's actually a pretty good situation to be in. And you maybe don't want to disturb that unless you really need to. So I would try and consider your current situation, and maybe then, I mean, you've said that you're trying to save a house deposit, so you are able to save. So that's also a promising sign too. You're not kind of stuck in this situation where you're working a job you like, but you also aren't able to save any money, so not able to progress at all financially. So that is a positive. So I'd kind of roll that forward in your mind and maybe practically in a spreadsheet or something, and try to imagine where you would be just based on your current setup if you were to roll things forward like 5 years or 10 years, and would you actually be happy with that outcome, whatever you think that might be? Because that could tell you a couple of things. It could tell you, okay, yeah, I'm actually happy. If I keep on my current trajectory, in 10 years, I'll be in a pretty good spot and I'm still able to do work that I actually don't mind doing. So that might make you feel a lot better about your current situation, or it might prompt you to think, no, in 10 years, I'd really like to be further along than that. And so if that's the case, then maybe the uni approach is going to make sense, notwithstanding the caveats and that Hayden and myself mentioned a little bit earlier that are important to keep in mind. But just to add on to that, if you are happy with your current situation, but you would also like to make some extra progress, consider if you're somehow able to earn more money in the industry or in the type of work you're doing now without sacrificing too much or without losing too much of that enjoyment. So maybe that could just be like extra hours or a little bit of extra responsibility or something like that, to where you're able to improve your finances and achieve that side of things, but also not lose the enjoyable work that you've got set up for yourself at the moment. So have a think about that and see if you can come to some sort of happy middle ground there and see if that works.
I think that makes a lot of sense, Dave. And I think just my last comment on this would be, because you mentioned being 25. I don't think from all the comments I made earlier, I don't think it's people going to do more further study or university that I've seen potentially cause them longer term grief. I think it's when people take a significant chunk of time out of being an income earner to do that. So the fact that you're younger might mean that, if you can keep this, you have this 9-day fortnight, 36 hours a week, this kind of job. If you can keep doing that and be happy and maybe put yourself through a bit of pressure for a few years with the uni, I think that's de-risking most of it, because you can come out the other side just generally being more educated, more capable. And if the opportunities aren't there, sure, you've got a little bit of a HECS debt, but you'll pay that off. And, HECS debts are very easy debts to manage in the grand scheme of, education globally. And you're not behind, because the last thing you want to do is, it's not that, the degree could be bad or further study could be bad. It's like, you don't want to like take time out, have full on study, and then realize that's delayed your house purchase by 5 years. And then now it's 2029 and you don't have a home. You're just going to start like, that's the kind, and I'm not saying that's what you would do, but it's really more about the time away from income earning and stable job than it is about the further study that seems to impact people. So that's really, for me, where the bigger decision lies. So let's move on to the next question, Dave. This one is investing $10,000 for a child. The question is, Dave's book has inspired me to stop spending so much money and start investing. I now use Pearler. You guys are both inspiring. That was weird to read out loud. Thank you, though. Me and my partner and I have just had a little girl. Congratulations. My nana has passed away and left her, I believe the little girl, $10,000. We are both wondering what your advice would be for growing the $10,000 for her future. What do you think, Dave? What's the best way they could, put that money to good use over the long term?
Gold.
All gold.
No specific investment suggestions at this point. But actually, after looking at the question, I'm not exactly sure if they're asking what to invest the money in or how to go about investing the money, because there's a couple of different ways you could look at it. So I don't know if they mean, what fund to choose or what strategy to employ, or do they mean, should I invest it in my own name or in my daughter's name or some other sort of an approach to take? Are you reading anything specifically from this question, or are you thinking it could go both ways like me?
I think it could go both ways. I read the question like they've just got $10,000 and they just want to do good with it. Yeah, full stop.
Okay, so there's a few ways that you could go about it, I suppose. Some of the ways that you can structure things for kids do get a little bit complex, because there's different ownership names involved and different things that you can do with tax and trust, different structures and stuff like that. One of them's called a minor trust. I believe can you set up a minor trust on Pearler, Hayden, to invest on behalf of your kid? Yeah. Okay. So that's one of the options. I would encourage you to read the article called Investing for Children by the website Passive Investing Australia. That essentially runs you through this option that I just mentioned, but also a bunch of other options and ways you can think about investing for kids specifically. As for what to invest in, I'm not sure if you would approach it any differently, mate, but I would probably just add it to my own personal portfolio. And the reason I would do that is because it's by far the simplest option. But the only thing that I might do differently is either invest in a different fund, so that then I know that money's separate, that money's not mine, and I can specifically track the growth of it over time. Or I would just open like an additional brokerage account. So then the money's at least separately accounted for. Not just, you're not having to track the value of it, apart from your current portfolio. It's all there separated practically as well. So I probably wouldn't do anything too fancy. I'm not sure. How about you, mate?
Oh, it's a good question. We have this come up all the time with our customers on Pearler. Speaking of Pearler specific, the two general ways, you can either invest the money under your own name, or you can invest under your kid's name, with you, holding it on their behalf. And it's like, there's a lot to unpack with the two, as Dave said, but the really short story is, if you invest it in your name, there's basically, it's very straightforward until the point where you want to hand it to them one day, in which case, if you transfer them the shares for them to own it, or you sell it out for them to have the cash, you're going to deal with tax, potentially, decades of tax. The flip side is, if it's in their name, it's always in their name, so they can just grab it when they turn 18. But there's lots of rules and thresholds and other kinds of things that carry along the way, and higher marginal tax rates and stuff like that. There's a lot to read about it, but that's your kind of broad two ideas. Either it's safely in their name, there's no transfer later. Personally, I'd probably more aligned with Dave. Partly this is just because I haven't had to think about it a lot personally. And I already have investments now that I'm hoping to hold for 10 or 20 years that I'm going to pay tax on later anyway, when I want to extract value from it myself. So I don't have a problem just investing it in my kid's name. If I'm trying to save for my family's future long-term anyway, there's going to be tax paid at some point. Obviously for some people it gets more kind of emotional. Like obviously if their child turns 18, like let's say I have a separate chess sponsored hin over here with money for my kid and they turn 18, there is a very different thing being like, oh, here's the like password to the account. It's technically legally my shares, not yours, but we should keep them there till you need it. Like that is a different feeling, which I totally acknowledge, but also I'm generally not in the business of thinking 20 years ahead with all this complicated stuff. I probably just would do it in my name, but I will fully disclaim I don't have children. I haven't thought about it a lot, and I wouldn't be surprised if that answer changed back and forth twice in the next 5 years as well. But they're both viable ways, and I think as long as you're doing something, that's 80% of the battle done too.
And it probably also depends on whether you're going to be adding to this investment as well over those, let's say it's 20 years, because if you are, then, well, there was one approach that I forgot to actually mention that I was going to say, which is that it's not going to matter. You could actually avoid the tax in 20 years' time by not selling your shares to give them the money or to give them the shares, but actually just having extra cash in 20 years to account for you gifting them an equal amount of money at that time, which is, it might sound like, oh, that will be a lot of money, but it might not be, because if it's 10 grand now and you get like an 8% return, it's probably going to be like 40 grand by the time they're 18 or so, which is not a massive amount of money. So then that's where the other part comes in. Are you going to be adding to it? Because if you're going to add to it and it's going to end up like 100 grand, then that's going to be a lot more cash that you're going to have to come up with, at that future later date. So have a think about that as well. But if it's just going to be the 10 grand and you're just going to leave it there, then you might just be able to pay for that with cash later and not have to worry too much about the capital gains taxes in the future if you were going to hold it in your own name. Because I would imagine that you're also investing yourself over the next 20 years. And so you're going to be a lot wealthier in 20 years than you are today. So you're going to have much greater capacity to hand your daughter, a lump sum amount of cash than you can now.
Yeah, for sure. I agree with all of that. There's so many different things you could do. I heard someone tell me once that they invest for their kids in their name, but mostly in dividend earning things, because one day they just want to, send all the dividends to their kids. And it's like, sure, that all makes sense. And for all you know, by the time you want to hand it over to your kids, they're getting a high paying job and you don't have a job anymore. You're like retired or something. And like the fundamental thing with this is all of the answers are all around tax. It's a tax conversation is what you are dealing with mostly. And again, all I'd say is weigh up those options, take a stab. The best part is if it's only 10K for now, to be honest with you, like whichever way you do, you can just change it later. Particularly if you invested in your name, like, okay, you invested in your name, great. It grows to like $15,000 over the next 4 or 5 years. You learn something else. You decide to sell it out and invest it directly in the kid's name, and like, okay, you lost $1,000 to tax. Like that's so the quantums really help de-risk that conversation, because the big scary ones are like people who would have $100,000, $200,000 of money, in the kid's name and be, looking at tens of thousands. Like it's so yeah. Point is that $10,000. I'm not trying to say that's small, because that's a wonderful sum of money to put towards a child, but it's going to be very difficult to make the wrong decision if it's in your name and you later decide to move things around. Like you're not going to think that you've evaporated anything. And remember, at the end of the day, you're only paying tax on stuff if the wealth has grown for your child as well. So, it's not like a bad thing. If the money goes down, you're not going to lose any money to the tax office or anything like that too. So that's probably where my best summary of it all is, Dave.
Yeah, I think that's well summarized. You don't want to get too, it depends how nerdy and technically efficient you want to get with these things, as always is the case. But yeah, as long as you get it invested and you can maybe add to it over time, that's going to be the main thing. It's going to be a beautiful gift no matter what. All right, we'll move on to the next question. And the next question is around home loan strategy. Hey guys, just finished listening to the latest episode of the podcast and it got me thinking about my loan. I've paid off 67% of my loan and I'm wondering if you're better off paying out your loan in full or keeping some money in there so that in the future you can always borrow against it and keep dumping into shares. I haven't done this yet because I'm pretty focused on the goal of having my house paid off. So yeah, just any more info or thoughts on this would be good. It's an interesting conundrum, mate. What do you think?
It's a great question. It's one I think Dave and I have dealt with personally as well at a point or another. I think there's a couple episodes we might have talked about similar things that could be worth listening to on this topic. Though my short answer with this stuff, Dave, is that if you are still an income earner, then if you can put the capital you have to productive use instead of paying down your home, that will generally yield a better result if you still have a journey ahead of you. You know, like you're not trying to relax straight away, but if you're trying to actually, you know, enjoy your life and de-stress things financially, then paying it off sooner can be a good idea. So I guess in summary, the two big factors for me are what's your income situation at the moment and how far out are you from wanting peace, quiet, and tranquility in your brain financially. They'd be the two biggest things that would swing that in a different direction for me. I mean, what do you think I'm missing there, Dave? Or what do you think are the kind of bigger parameters to think about?
No, I think that is actually the main thing. The only thing that I'm also reading into the question is the potential desire for having optionality by keeping your loan open. That's the only thing that I can think of here, because obviously this person is quite happily focused on getting rid of their home loan. So they're already quite content with their strategy rather than focusing on investing. So I think they're quite content with that. So the only other thing is whether it's worth keeping the loan facility open either now and sort of optimizing that somewhat, or in the future when the loan is technically zero to possibly use as optionality, whether it's to invest in shares if the market's had a big drawdown, or even to use, I think not many people think of this, but even to use as essentially a gigantic buffer. So you could have a home loan that you've paid off, but then you keep the loan facility open and maybe you're still working, so you apply to, you know, increase that loan facility to maybe 200 grand or something. That is a monstrous sized buffer that you could have access to and you could set that up before you actually leave the workforce.
If I could ask a kind of potentially silly question, you might be able to educate me here, Dave. You know, this question of like, should I keep the loan open versus fully paid off? You know, should I leave $50 there or whatever the hell the amount is? Is it fair to say that at the end of the day, there's a physical cost and a process to go through to get a loan or, you know, refinance the house. And then there's also a kind of a monthly cost to keeping the loan. You know, generally, like if you have a loan open, there's usually going to be some or yearly fee that depends on the bank 100%. But is it just kind of weighing up those two costs and the headache or the stress of knowing you might have to ask, you're still asking for a loan. You can't just get that loan in the future, right? You can't just refinance your house like that. Yeah, still have to ask a bank to tick the box, right?
No, that's true. So it is worth, especially if you're in retirement. If you're in retirement, but it's not going to happen. For the most part, there might be some extenuating circumstances where you can, but mostly you're not going to be getting new finance from a bank. So in that case, yes, it does make sense to leave the facility open if you can, because there is real headache and real process and a real cost involved in getting the loan in the first place if you were to pay it off and then all of a sudden decide you want access to bulk money again. So that's definitely worth considering. So if you did want to keep optionality at the same time, one way of doing it instead of paying off the loan would be to more or less park the money in an offset account attached to the loan where you can still get the money out whenever you want because it's just in an offset account. And then have the offset account, I know someone who's done this not too long ago, have the offset account essentially equal to the loan balance. I think this is fairly common these days. And so you might have a loan for 300K that you've been chipping away at for many years, and you've got bulk savings of 300K in an offset account. So essentially what would happen in that scenario is each month the repayment for the loan would come out. You would get charged no interest because the offset account is equal to the outstanding debt. And then essentially the loan repayment would come out, whether it's $1,500 a month or $2,000 a month, and your offset account would go down by $2,000 and your debt would also go down by $2,000. So your credit facility or your loan limit is actually going down steadily over time, as would be expected with a normal sort of home loan period. So that's one way you can keep the money fully accessible with absolutely no, I suppose, potential headaches or problems whatsoever if you wanted to run a scenario like that.
I imagine there'd be very few scenarios, Dave, where if you had the money to fully offset the loan, you'd actually want to close the loan facility, right? Would it only be if you want more credit? Is that probably the only scenario? Or like if you are retired, to be clear, but excluding that one?
No, I think people genuinely like getting rid of the loan and being completely done with the bank.
Yeah.
And being I just want to take my money, get rid of the loan. I just want to be done with it. So they get that psychological weight off their shoulders because the loan no longer exists. It's been destroyed, right? So I think there's a real sense of satisfaction that people get from actually that account being closed.
Yeah, makes sense. I mean, I guess like for a lot of people, it's like a 30-year journey sometimes, you know? So for sure, I can imagine it. It's absolutely cathartic. I mean, I'm only clocking over 12 months of my apartment now, right? So I'm probably quite fresh in the scheme.
You don't have that hatred built up towards your home loan that many people have.
Yeah, I haven't had that bad experience with the bank just yet. I'm sure it'll come.
Do you have any plans, mate, around what you think you might do when you, I won't say retire, but don't have to work so much anymore or are able to do something else? Do you plan to keep some sort of a home loan open and kind of keep that as big as possible so you can keep investing aggressively? Or do you think there will be a time when you just want to be debt free and not have to worry about any more, even if you're not necessarily getting the highest possible returns long term?
Yeah, I mean, I've only really been in debt for 12 months, so I feel like I'm still very early in my learnings about it and myself and how I feel. But at the moment, my attitude would be like, I mostly see keeping the debt around as a way to use that money for something more productive. I can't imagine personally a scenario where I'd want to camp a lot of the money in offset just to kind of keep it there. I feel like I would either pay down the loan, pay it off and be done with it, or I'd be using the money for something else. Would probably be my approach at the moment, because the only reason I don't mind putting up with the bank is because the idea of, not owning a home and stuff is because there's something good happening there. Particularly, I think I've said this to you before, but I used to get really excited about offset accounts when I thought it reduced your monthly repayments.
Well, it does if you've got an interest-only loan.
If you got a P&I loan, I thought it just reduced I had a really dumb view of how loan repayments worked even after I'd bought the place. And now realizing that, if you put money in offset, the bank takes the same money every month. I'm just a little sour on it too, because I feel like I have all these people who used to tell me things like, oh, just, put all your money into offset as if it's like financial relief. Like people talk about offset like it's financial relief. And it's like, it is no financial relief. It does nothing to your cash flow. It does nothing to reducing. The only thing it does is like reduces the time it takes you to own your home from 28 years to 24 or something. And so I think I'm still just processing my revelation about how offset accounts actually help or don't help. So that's why I kind of sound sour about it at the moment. But, I'm an evolving human.
Well, it's just like keeping all your spare cash in the loan instead of in a transaction account.
Oh, yeah, for sure. It's the best place to have the money if you've got it and you want to kind of keep it, liquid and in cash. But yeah, I don't know. I'd probably either be using the money for something productive or I'd just get rid of the loan in my case.
And just as a follow-up question to that, if you were in a scenario where you had a very expensive home, would you feel excited about having a very expensive home paid off, or would you feel like, God damn, that's a whole lot of cash tied up in a home? I'd rather leverage that to then invest the money? Because I find some people are in two camps on that.
That's such a good question, Dave. I have yet to experience a emotional desire to own the place I live in, right?
Oh, interesting.
So me purchasing an apartment was economics motivated me. It was high interest rate. The market was quiet. I had enough money then after 10 years of saving. So the short answer is I wouldn't want the cash tied up in the place. It would feel crazy to pay off a home and have, whatever it is in Sydney, $2-3 million just locked up in bricks, because I don't want my money, I don't want my money locked up in bricks, because I don't care if I own or rent at this point. I'm sure someone else in my life.
What about gold bricks?
Gold bricks. I'm sure someone else in my life will make the decision for me about paying it off or not, because they probably won't be as economically, motivated. But no, the home ownership and all that stuff at this stage for me is not a motive. It's mostly economics.
Interesting.
Yeah, I don't expect a typical person to look at that and think that makes sense. I expect them to look at it and be like, what's wrong with him? So, and that's okay. But I mean, maybe that'll change with Sure. To be honest with you, I feel like a big part of it is, and I'm noticing this is rarer and rarer. I moved out of home when I was 18 and I rented till I was 30. And like, I don't have a lot of friends anymore that have done that. They've either like, there's a whole spectrum. There's like people who aren't even close to owning a home, so they don't think about it. But then the other contingent of people who can afford a home, maybe like better jobbed people or better wealth and stuff, is like either their parents helped them out, so they got into the home market at like 23, 24, so they didn't rent for that long, or alternatively, because they grew up in Sydney, they still live at home till they're 24, 25, and they just stay at home till they own a home. So I think in general, I have a much lower sensitivity to renting because I'm 31. I've done it for 12 years, 12 years, I think. And that's like, I'm just like, I'm over it. I'm not over it as in like I'm over renting. I'm like over all the problems with renting. I've rented. I think there's good things and bad things. So I think that's a big part of it, is I think a lot of the love for owning your own home does come from a hatred of renting,
It's interesting because you would think in theory the person who's rented the longest would hate renting the most.
There's things I hate about renting, for sure.
Yeah, of course. And there'll be things that you hate about owning, I'm sure, too. If they haven't popped up, they'll pop up over time.
Strata.
Yeah, that's one. I'm probably in a situation somewhat similar to you where I've actually rented and owned for a similar period of time each, maybe like 8 or 9 years doing each. Probably 9 years doing each, something like that as an adult. And
you're old.
I also, I am. And I also don't really feel the same passion that other people have about needing to own the home that I live in. I don't know. It's just not there. People are like, oh, it's different when you own your home, but I don't feel it, man. I don't know.
I feel it, but there's all these other problems. Like what I notice is like I have if I leave Sydney for 4 days, I have a marginally higher baseline anxiety level now that I own an apartment as opposed to rent. Because I'm like, what's going to happen? Is the building going to burn down? Is like this going to happen? Is that going to happen? Like what's going on? Like even a good example, I live on the top floor, penthouse suite of a 2-story building. And it's like, there's like carpet in the stairwell. And there's this owner or renter, I'm not sure, who's across the hall from me. They always have their garbage bags. They don't want to take their garbage bags down a story to put them in the bin. So they leave them outside their apartment, which I don't have a problem with, to be clear. I'm pretty chill. But sometimes they leave the bags out there and there's just crap in them. And it just like spreads on the carpet and there's like oil stains and smears all along the carpet in the common area. When I was renting, I just used to not care about that stuff. You'd see that and be like, whatever, I don't care. Now I'm like, this is like my stairwell. This is the stairwell I'm going to have to bring someone up one day to show them the apartment to sell it. This is the stairwell that we're going to have to redo the carpet one day. Like all of these things are on my mind. And I want to admit, a bunch of this is obviously common property specific and like strata complexes. But also I've got friends who own homes who they discovered, like I have a friend who bought a beautiful little cottage up near Coffs Harbour. And it's been like raining up there. And now they've had to throw out like a third of their clothes last week because of mold that's like built up. I'm not saying that's a buying versus renting problem. It's more just like the type of place, but it's just like, there's just different things, like I have different problems now. And I can't say on balance, I feel better. I just feel different. And, I think the first thing that would upset me would be if I was renting and I had a child and I told that child we're going to have to move because some random person made a decision, some random person we don't know and don't care for and they don't know us decided to do something different with their life. And now my child is crying in front of me. Short of that, I don't think I really mind. And I will say one more thing, Dave. I used to I have a lot of friends that I rented with and, the big thing used to be, oh, well, if you're in a rental, you have to move sometimes. Moving is really difficult. And I empathize with that. I've moved so many times in go-get vans you wouldn't imagine it. And it's really painful. But then it's like, if you can afford a house, like I've gotten to the point in my life where I can afford a house and afford mortgage repayments, you can also afford a removalist at this point. So it's like that kind of like the headache of moving that you feel as like a 22-year-old who's poor is very different as you get older and you have more capacity to manage the fact that, or even like now I have enough money that if I was renting again, I could just throw $20 a week on top of whatever rental price. I couldn't going in market, because, I've been poor enough to look for rentals and just been like, I can't afford any of these, and everyone keeps outbidding me. So I feel like as you get older, a lot of the problems with renting change, and a lot of the feelings we have with renting can also look back. When I say older, I mean, older and in a better financial position. We kind of look back and project some of our like poorer years to some extent, because a lot of the renting problems I think are tied to financial situations too, if that makes sense.
Yeah, it does.
That was a lot to unpack. I'm sorry about that. Anyway, Dave, enough of that. Let's move on to the next question. Stop talking about me and my random pointless thoughts. So the next question is all about AI, property, and future markets. It sounds interesting. The question is, long-term fan of the show and avid reader of Dave's book and blog, I used the Strong Money blog to assist in setting up my debt recycling, and now I have a fully debt recycled primary place of residence. Yay me.
Nice.
Now that I'm heavily invested in shares and crypto, I'm looking at getting an investment property to diversify my income sources. With the rise in AI and robots, I can see a future where new companies are formed and run without external funding, share listing, or private equity. And when AI becomes super intelligent, do they just break markets by becoming the best traders or investors? As the world goes more digital, I am thinking that at least one residential investment property in a coastal location is a good way to hedge my bets and diversify my income, even if the yield is low for the first decade or so. Keen to hear both of your thoughts, and if Dave would keep a few of his properties for income instead of switching it all to shares.
It's a pretty damn interesting question, mate. There's probably three things in there that we could discuss. So the first one is, let's talk about AI's impact on the market. So essentially the vibe that I'm getting here, or the concern that I'm getting here, is that AI will essentially destroy the idea of investing in the share market, since no companies will need to list, since they'll effectively be run at, I guess, no cost or very low cost. You won't need any funding from anyone else. You'll just be able to build very large companies without staff and without tangible things, I guess, in the world. But I'm not sure. I mean, I understand where it's coming from, but I'm not quite sure that I buy that as an idea. I do think it will have some sort of an impact, and I absolutely think that AI will be involved in trading if it's not already. It's probably already rolling out to some degree, and so I definitely think that it will eat into what kind of opportunities are out there in the market, and that probably active investing will get harder, if anything. So I think that that's definitely going to be the case. It's also worth remembering that people will be using AIs to follow different strategies, and they won't always be the same strategies, and the AI themselves will be able to detect what strategy will be like more profitable at different times. And so you would think that they would compete with each other, and then they would arbitrage those opportunities away as well. But as for the no listing and no funding sort of things that AI might affect, Hayden can probably talk about this better than me, being a company founder himself. But I don't think that that's likely. I think companies are still going to want to list on the share market for various reasons. One of those reasons is that just typically tends to be where you get the highest valuations for your company a lot of times. So valuations for private companies are often lower, and the reason for that is that the people that are funding those companies or owning those companies are taking more risk because they have no liquidity. Their money is essentially trapped in the company. They can't just get in and out if the industry changes and they want to kind of pivot their money to something else. So that's one reason. And another reason is that founders are typically wanting to list their company not just to raise a bunch of money to grow the company further, but also to cash out some of the wealth that they've built inside that company, because they might have built that company over the last 5, 10, 15, maybe even longer years. And so they might have a significant amount of their wealth tied up in that one company, and they might want to diversify themselves, not like sell everything and abandon the company, but like just kind of dilute themselves and get maybe 10 million out or 20 million out or something like that, so they can buy themselves a nice house and set up a little investment portfolio for themselves and go on a few holidays and different things that they've been probably grinding and working very long hours for a very long time. So that's another reason why I think that AI is unlikely to impact that sort of thing, because those types of scenarios I would imagine would still play out in the future. And then you've got to remember that even if you have a digitally dominated landscape, there's still going to be a whole bunch of companies doing very tangible things in the world that needs that needs staff unavoidably, that needs equipment unavoidably, that might need factory and different things. So not everything will be digital. We're still going to live in a semi-physical world. I would like to hope. I don't imagine we'll all be just staring at screens and everything will be goo in the next 10 or 20 years. So I'd like to hear Hayden's thoughts on this, mate. How do you see AI affecting not only startups, but markets?
Dave, you have no idea what you're talking. No, I'm kidding. It's actually all pretty reasonable. So
I'm just guessing, mate.
Yeah, no, it's Dave's on the money again. Look, I don't know. I get the concern, and I get the concern because I deal with this stuff all the time, and there is so much noise in this space, and every single person has a different view on the future. And everything people say, including what Dave says, including what I'm about to tell you, is probably wrong. So no one really knows what's coming. What I'd say is when the internet kind of first started booming in the 90s, if someone said, oh, the internet's going to take over, everything's going to be on the internet, we're not going to have any more physical stores anymore, everyone's just going to buy food on the internet and do everything on the internet, you'd look back at that with hindsight and be like, well, that doesn't make any sense. The internet just supercharged stuff and it changed the dynamics of what went on. And there was some interesting long-term things we didn't expect. Like 20 years after the internet was popularized, we started having restaurants selling food that was delivered that they didn't have an actual place you could go and pick it up, these ghost kitchens, right? Like it just changes the dynamics of stuff. And we're going to see the same thing with AI. Like you're going to start seeing different size companies. You're going to see smaller companies with big valuations because, more AI agents or whatever are being used instead of other employees. You're going to see different types of businesses grow and various other stuff. But by and large, the world isn't going to be vastly different. I can tell you one thing personally from my time with a finance company. There's a bunch of stuff that if technical people like me could digitize, we would, but the world is painfully analog in a remarkable degree of capacities, even in the service industry. And what I mean by that is an AI couldn't just turn around and start drop shipping on Amazon or something because, well, maybe that's a bad example, but they can't just start selling something or become a supplier at Bunnings, because to become a supplier at Bunnings, I'm sure there's people who work there that you have to talk to them or meet them or do something else. The world is actually ferociously inefficient in many ways a lot of the time, which does put a cap on all of this. So what I'd say is don't get too worried about this stuff. This stuff's also already existed. We've had intelligent computers doing trading on stock markets for a while now. That's what a lot of these companies that do high frequency trading is. They've been using AI or equivalent. I think just for listeners generally, it's important to point out, we've been using AI and software for a very long time in many, many different facets. What has been popularized recently is a form of AI called generative AI, which is AI that's very good at basically creating stuff by remembering a whole bunch of seeing everything that's happened in the world and being able to create new things. And that's where a lot of the really interesting stuff and whatnot has come from. So yeah, there's going to be some industries that are pretty significantly disrupted. Telecoms in terms, customer service, things like that. But I wouldn't go worrying about a change in the world order or fundamental change in how, markets or investing works. It'll just change the world in a way, just like a lot of technological advancements have.
And do you see startups being the same, whereas they're still going to want to list on the market and we're still going to have that sort of environment?
Yeah, I mean, how the stock market has changed. Stock market's changed over the years. Kind of pre-COVID, we were peaking, I think, with in the US, it was something like 4 out of 5 companies that were listing on the NASDAQ weren't profitable, and you wind the clock back 15 years before that was different. I don't really think there'll be a case of startups see the benefit or not the benefit of listing on public markets. It's just not for every business. Some businesses like it, some businesses don't. Dave's right about, sometimes private markets don't value things well enough. Sometimes private markets don't value things or they overvalue things too. If you look at Canva, for instance, and don't quote me on this because I don't spend much time thinking about it, but, Canva will have a valuation as a company that'll be $40 billion or something. And the reason they'll spend a lot of time preparing for a public launch, on the NASDAQ is because they worry that, the general market won't respond as well as how excited all the private investors are, right? So, but, they still want to launch on the NASDAQ because there's lots of benefits for that. Companies like it because they can pay their employees in stock. I'm in a startup right now. We can't pay our employees in stock because we're a private company. We can pay them with the rights to stock in the future. And that hits very differently to, my close friends who work at other, big companies who the company says, here's your pay package, but then we also give you stock every year and you can sell that stock. You can do anything with that stock. You can borrow against that stock. You get enough stock, you could literally take out a loan against it, So it's just different. I don't expect that there's dramatic changes. It'll just be like evolving world as things come and go, but by and large there'll be private companies, there'll be public companies.
All right, so the other part of that question was whether I would keep my properties or some of my properties for income, and the answer to that is the dwindling one, mate. The answer to that is no. I'm currently selling one at the moment here in Perth, and after that there will be 2 left, and those are planning to be sold as well. So the reason I wouldn't keep them for income is because that the income from those assets after all of the costs are accounted for is fairly low. So it's something like 2.5%, let's say, net income return after costs. So that is not terribly high. So I can see the point in owning properties alongside a share portfolio for the sake of diversification and having something different. But for an income source, I probably wouldn't, unless there's always circumstances where it could make sense. If I did a thought experiment and be like, well, if the property market's collapsed, but you were still going to be able to reasonably rent a property for, a half decent rent, then it could make sense because the yields would be quite high. And then after costs, you're still going to be getting a pretty decent income return. So there is scenarios where it might work. I'm not planning to do that, but I could see a scenario where it did happen. Maybe something else like a dual occupancy property or something like that, or like I said, buying in a depressed market or somewhere that's gone nowhere for a long time. That might end up having some pretty decent results. But I just wanted to touch on something that the questioner said. So they said that maybe a good way to hedge my bets and diversify my income, even if the yield is low for the first decade or so. So I just wanted to touch on that. So the yield itself, yield is not the same as rent. So the yield could be low forever. The yield could be low basically for the lifetime that you own that asset, even if the rent goes up over time. So what will happen is the rent will go up over time, the value will go up over time, but the yield is a percentage of the asset value that you're getting in rent. So it's still going to be likely a low yield over time. So you're basically just going to end up with an expensive asset that you have a lot of capital tied up in that's still getting a low yield that would get a better yield elsewhere potentially. So I just wanted to differentiate rent and yield because that's not the same thing. Otherwise, that the best properties would be the properties that you bought. Like people look at things in terms of purchase cost. I don't really like that too much because it prevents you from seeing with a clear head what the best thing to do is today with where your money is today, whether a different asset or a different investment might be a better choice. So I don't know if you look at that differently, mate, or if you're planning to own any property or anything else as a diversifier in terms of income sources later. But I'm not personally, but I could see a scenario where I did it just for something different or for an opportunistic investment or something like that. But the plan is that that would only be in addition to like my baseline FI portfolio that I would still have in shares. So I wouldn't do it as part of my portfolio. It would be like an extra, if that makes sense, on top of the base portfolio.
That makes a lot of sense. I don't have a lot to add, Dave, because at this point in my life, I have no interest but to stay far away from investment properties pretty much for the reasons you mentioned. I could never make the mathematics work against what they are. And don't get me wrong, I like the idea of an investment property. I remember years ago, my close friend from Germany told me that her mum bought their family home for 300,000 euro. 12 years later, it was only worth 350,000 euro. But the gross rental yield that they could have gotten from that was 12%. And I remember thinking, that's just everything I've ever wanted. I'd love to buy a home that just basically stays the same price, but like brings in good money. That sounds amazing. So I'm not like anti-investment property. I'm anti the economics of how our market is with all that stuff.
It's super interesting you say that because I don't know where I said this, but I said not that long ago somewhere that was like, people think I'm not really, super in favor of property, especially to live off. But that's not actually true because if I was in the US where they have many, many decent cities where you can get yields of like 10%, 11%, something like that, somewhere in the region of like 8 to 12% is pretty reasonably achievable over there. You're going to be getting a pretty impressive net income from those properties. And you also get the leverage as well, which is what we get so excited about here in Australia. So I would imagine I could easily see a scenario where I'm exclusively a property only investor in the US just because of the options that they have over there and being able to live off a property portfolio much faster than you can here. I could easily see that happening. So I don't want to like discount it or make people or have people think that I'm just operating on some ideological, mindset. That's not the case.
That's so interesting. It's funny you say that, Dave, because one of my friends that I made when I was working at Microsoft, they were in Seattle and they were working full time. And I said, oh, you're going to come back to Australia and buy a home? They're like, oh, no, I don't want to buy an investment property in Australia. This would have been 2014. They were like, I'll buy an investment property in Seattle. And I was like, is it expensive? And they were like, oh, I can buy a one-bedroom apartment for about 100,000 USD and I can rent it out at about a 10% gross yield. And they were like, I have a high income. I'll just do that. I'll just keep buying about an apartment a year for the next, 6 or 7 years and just build up. And they were like, I build up my property empire in Seattle. And then when that finally gets settled, I'll sell it all and buy a nice house in Australia. And I was like, I remember hearing that and being like, that's really complicated. Like 21 years old, just confused by the prospect. But now I want to check in with them. I wonder how that all went. But yeah, to the point, there's lots of opportunities out there in the world for property. And I guess Dave and I probably just question in many cases in Australia whether there's an abundance of them right now with how the market's shaping or shaped out.
Yeah, it's just not a natural choice for someone that's looking for income. Like there is areas, I'm sure, where you can get a decent income, but in capital cities generally tends not to be an income play. It's pretty much all about leverage growth, and then that's about it. Unless there's, you might have some unique type properties as dual occupancy or something like that, or apartment buildings or something. But those are the exception.
Can I really quickly ask, Dave? I know we're running super overtime, but have you ever considered an investment property that you then Airbnb out to, get a massive yield?
Too much work, man. Too much work. Too much work. God damn, you're like running a mini hotel. That's way too much work. That's way. I mean, I did briefly look at it, like in a holiday spot where my mum lives. I kind of did some numbers on that, and I'm like, yeah, okay, you could turn this into a pretty good cash flow spinner. But then it becomes its own sort of part-time job, because even if you're not actually there doing the cleaning and doing things yourself, you're still having to manage a manager, and you're still possibly having to deal with because there's going to be way more problems because you've got way more tenants, right? You've got a tenant that's coming in every 3 days. Like it can definitely work, but it becomes its own job. So I don't want to think of it like a pass. I'm much more of a, mate, I'm much more of a passive investment type guy. I'm not so much
keep it simple.
Yeah. But it can work for the right person. Absolutely.
Cool. All right, Dave, that's probably enough yibba yabba for one podcast. Let's do a quick wrap up, key takeaways. So on gold, we've talked about gold has performed relatively well. Will it outperform the share market or be safer than the share market long term? Dave and I have our personal views, but, we don't study this stuff full time and haven't thought about it for years on end. So, time will tell. Make your own decisions, go and have a look at that if you want and whether you think it's a worthwhile idea. We talked about careers and whether it's worth changing careers, going and studying again. That was another one of those ones where it really depends on the person, though we did talk about a quick summary of it was it really depends on the type of career you're chasing and what the impact is in the medium term if you have to take time off work and if that impacts your financial goals, for instance, not being able to buy a house sooner. We talked about options when it comes to investing with kids and how you can invest in your name for your child or your kid's name and how they both have different tax implications. Though at the end of the day, if the amounts are small, the penalties in changing your mind later in terms of tax are low, and getting started is really just the most important step there. We also talked about home loans and whether to keep money in offset, whether to keep the a loan open at all, and some of the benefits psychologically of closing the loan versus some of the benefits of having access to cash if the loan is still open, and just generally had a conversation about, when it comes to, security and financial benefits of having a home fully paid off and yours as opposed to dealing with the bank. And then lastly, we had a quick conversation about AI and property diversification. Won't recap that one too much because we just talked about it, but Dave and I both said that we don't think AI is going to destroy the world or shake it up as much as our questioner asked, and it's mostly just going to reshape industries like a lot of technological advancements in the last 30 years.
Very good, man. So thanks for the questions that were sent in today. If you've got a question that you'd like us to answer on the show, you can always email us and you can send those through to hello@aussiefirepod.com. And we absolutely love getting those questions. So make sure you're sending them through, even if you think that they're a little bit different or a little bit unusual. And of course, you can send through the case studies. We're still getting to those and working through the backlog that we have. So there's probably going to be another one of those dropping very soon. So stay tuned for that. But that's about it for today, guys. So thanks for listening and we'll catch you in the next one.
Thanks, everyone. We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to Pearler.com to browse our resources, calculators, and community insights. Pearler is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk and past performance is not a reliable indicator of future investment returns.